Hi, it's Tuesday, May 10th, 2016. Today I'm talking about two investment giants who've recently come out and said basically they're preparing for a market crash, stock market crash. And the reason I'm doing this video is because I think it's important to pay attention to these guys, especially when they're Icahn and Stanley Druckenmiller. They are like legends in the investment business. First of all, though, I'd like to talk about the markets and my take on what's been happening. Markets, usually frustrate investors or speculators. There's an old adage that says, markets can remain irrational for longer than you can remain solvent. So it's a frustrating business, speculating or investing. We've been almost for a whole year making this top, in my opinion, in the Dow Jones Industrial Average and the S&P. The all-time high in the Dow Jones Industrial Average was hit last year on 18th of May, and right now we're the 10th of May 2016, so it's almost a year since we've had the top, and that was 18,365 approximately. And as I speak this morning in London, the Dow futures is up 103 points, and it's at 17,800. So we haven't fluctuated much from that high, even though we've had some sharp drops last August and this January. Last August, the Dow dropped to around 15,200. So we had a 17% correction, which does not qualify as a bear market because usually it needs to be 20%. And then January this year, we had a 15.6% correction. We got down to around 15,500. So yeah, it's been very frustrating, and it's taking a very long time. And I'm sure a lot of people that were very bearish at the beginning of this year and thought the end was coming for the markets, crash, they've turned bullish and they're just frustrated. So this is my take on what's happening. I think the markets are just frustrating people, but you can't lose sight of the fundamentals, and you got to be patient and not risk too much money. Don't get leveraged or else you get wiped out. Well, first of all then, I'd like to talk about Icahn, and I'll read a little bit about what he's done from Wikipedia. So Carl Icahn was born in 1936, so he's 80 years old. He started his career on Wall Street as a broker in 1961, and in 1968 he formed his own securities firm based on risk arbitrage and options trading. Well, risk arbitrage is trying to, make small gains, but with a lot of money on things that should be the same and aren't. For example, if a stock is quoted on one exchange and then on another, and the price is not the same, he'll take advantage of that arbitrage. He'll do that with stocks, currencies. Nowadays, it's not as easy because you've got computers and not as many exchanges. But that's how he started out, and he owns 90% of Icahn Enterprises, and his net worth is $18 billion. So he is a legend. He's made a lot of money, and he's very wealthy. $18 billion, and that's the background of Carl Icahn. And now for the recent news that's come out, there's been a 10Q disclosure, which is like a financial market disclosure that people, funds like Icahns and have to make every so often, and so it's called the 10Q, and it's pointing to a net short position of Icahn Enterprises of 149%. So he's gone from being net long last year, and he's now net short 149%. And this I'm reading from Zero Hedge article that just came out. I'll put the link below to it. And the CEO for Icahn Enterprises, which basically is 90% owned by Carl Icahn, and it's 90% his money. In the recent earnings call interview on the 5th of May, so 5 days ago, he said, and I quote, "We're much more concerned about the market going down 20% than we are of it going up 20%. And so the significant weighting to the short side reflects that." So yeah, that's Carl Icahn, net short big time, 149% for his fund. The second investment legend or giant I'm going to talk about is Stanley Druckenmiller. I have spoken about him in recent videos, but it's interesting to put him together with Carl Icahn because they've got the same view, and I think it's important for people to heed their warnings. And basically his background is in the hedge fund industry. He ran Duquesne Capital Management from 1986 to 2010. He returned 30% on average per year to investors, so very good track record. He also worked for the Quantum Fund, which is a fund founded and owned by George Soros. I know a lot of people don't like George Soros, but I'm just talking about business here. And he helped George Soros in 1992. He was working with him when they kind of broke the Bank of England and made $1 billion from their bet on the pound, crashing, which it did. September 1992, Bank of England had to raise rates from 10 to 15% when that happened, and then they cut it back to 10. It was a mess, believe me. And at a recent Icahn conference, which is one of the most important conferences for the hedge fund industry, he made a speech, and a lot of people there were saying he sounded apocalyptical and he was very bearish. And one of the interesting points that I took out from his interview, which is actually published on Zero Hedge, and I'll put the link below as well, he starts talking about 1981 when he started out in the business, and he's saying that 1981 is like a mirror image of where we are now. He says it's a mirror image of where we're now. Sorry for that, the phone just went off. And back then, the 5-year yield on the Treasury was 15%. Real rates are 5%. And, capital investment had to be done very carefully. You couldn't just say, oh, I'm going to borrow this and do this. It had to be for projects that were really studied carefully, so, there was no, capital wastage or malinvestment. Well, I'm sure there was some, but not as much as there is today where, rates are like 0% real rates, and, credit is abundant. And back then he goes on to say as well, central bankers, in this case, Paul Volcker, were much more longer term thinking. He didn't mind putting the country and the world through pain with his 20% interest rates instead, to eliminate inflation. And so he's basically saying back then, the markets were very cheap, capital was expensive, the reforms and restructuring were being done by the central banks, the politicians, and and that was the best time to invest. And for the next 25 years, he says, we had a bull market in financial assets and stocks and bonds, and it's still going. But basically now he's saying that we're at the mirror image. Rates have never been lower. Real rates are negative if you, calculate for proper rising cost of livings. In Europe, we have real, we have negative interest rates, which is something that is unheard of and seems really irrational. And nowadays, central bankers, they only seem to be worried about, the stock market. That's what he says. All they're worried about, if the stock market or the S&P drops 20%, they want to make sure it doesn't. And we can see by the drops we had last August and now that, the market's bottom just before that 20% level. So he's saying, they're much more short-termist, and all they care about is the short term, and that the stock market doesn't, correct. And the other thing he points out is that leverage now, is more than doubled what it was in 1981, for example. So 1981, there's a lot more room for leverage to increase. Right now, U.S. total credit market debt as a percentage of GDP is roughly around 355% of GDP, and back in 1981 it was around 160%, maybe a little less or more. So basically he's saying, there's no more room for things. And nowadays, with the Fed, running this policy of very accommodative policy of zero rates and QE. I know they've stopped QE, but they've done it. They haven't reversed it. That's not encouraging, corporations or government to restructure or, reform. And he says as well, Druckenmiller, that, don't hold your breath as far as, government or politicians reforming. So he says the only way for things to correct is for the market to correct, and the market to do the job of the correction that the Fed hasn't allowed it to do with its hugely accommodative policy. And basically, the other thing he says, the Fed has been borrowing from the future. Basically, that's what credit is, when you borrow from the future to spend now. And he said the U.S. is, the Fed has never borrowed from the future as much as they're doing now. And the other thing he talks about is that about corporate profits, peak corporate profits and cash flow. He said that peaked in 2011, and that now cash flow is actually getting negative. So, it's not good. And at the end of the speech, he says the following, which is really interesting. I'm going to quote this. He says, "The lack of progress and volatility in global equity markets the past year, which often precedes a major trend change, suggests that their risk-reward is negative. Without substantially lower prices and or structural reform, don't hold your breath for the latter. While policymakers have no endgame, markets do." So, he's saying that look out, because policymakers, politicians and central bankers, they don't have an endgame. All they want is to keep the game going, and to keep the stock market up there. And the politicians, all they want to do is borrow, for their programs. But he says the markets have an end game, and he thinks they're near. And then I quote as well, he says, on a final note, what was the one asset you did not want to own when I started Duquesne Capital Management in 1981? Hint, it has traded for 5,000 years, and for the first time has a positive carry in many parts of the globe, as bankers are now experimenting with the absurd notion of negative interest rates. Some regard it as a metal, we regard it as a currency, and it remains our largest currency allocation. So he didn't give you the name, but all of you know what it is, gold, right? And he's invested about $900 million of his family fund money into it. So it must be worth about, I think he did it last year, throughout last year. So now it must be worth at least $1 billion. So that's his biggest position and biggest currency allocation. So yeah, so my conclusions is that, yeah, markets can be frustrating and can usually take a long time to turn. You know, you look back at 2008, Bear Stearns collapsed when it was taken over by JP Morgan in January of 2008. And it took another 10 months for the final meltdown in the stock market in October 2008 to happen. So in the interim between January 2008 and October 2008, I think a lot of people said, yeah, the scare is over, things are fine now. You know, Bernanke said, you know, subprime is contained. So yeah, we have to be patient. You know, the stock market topped last year in May, and we're still very near that top. But I think, you know, things are going to get worse and for the stock market. And yeah, these guys are hugely short and prepared for it. So if you like this video, please press the thumbs up, share it with friends, and subscribe to my channel. Thanks. Bye.